Hi, good morning, everyone. And thanks for joining us on our weekly morning call for the 18th of April, 2022. So for today, we'll be running through a condensed version of our US Big Tech strategy that we presented on Thursday, followed by Singapore REITs Monthly. And then we'll have a Phillip on the ground for G.H.Y Culture and Media, and we'll end off with our usual Singapore Week. So without further ado, I'll pass my time on now to Timothy to get us going. Tim?
Yeah, thanks, Jonathan. Okay, next slide. Okay, this is just a summary of our big tech strategy. The big tech stands for the FANGs, which is Facebook, Apple, Amazon, Netflix, Google, and Microsoft, the biggest tech companies in the world. Our title is called Selective Posture, mainly because we are more selective among the 6 FANG companies, given that the environment, there's a slowing growth environment and also valuation compression after a pandemic spike. Next slide. Okay, so our macro themes is a slowing down of the economy and also the winding down of the work from home effect. So there's a slowdown. So the first question we will look at is the Nasdaq's performance, especially when the yield curve inverts. So the yield curve inversion, which recently happened, is a good indicator of recessions, especially for the GFC and also the dot-com boom. It predicted the past 6 to 7 recessions accurately. So we just want to look at how the Nasdaq performs whenever there's a slowdown in growth or there's a signal from the yield curve. So if you look at this chart, it shows the yield curve versus the Nasdaq. The red line is the yield curve, which is the 10-year Treasury yield minus the 2-year US Treasury yield. So it's just a difference between the yields of these two Treasury bonds. And the blue line is the Nasdaq index, which is the tech index in the US. So if you look at this chart, the yield curve, when it flattens, when we say the yield curve flattens, it means that it's just going down. So when the red line goes down or flattens, you can see that it doesn't equate to a correction in the Nasdaq index. So the Nasdaq can still perform when the red line goes down. It's only when it inverts when there's a signal of a recession coming up. So when it inverts, it means that the red line goes below zero, the zero line. So if you look at the chart, you can see the green circles is when the periods when it inverted and went below zero. So when it went below zero, you can see that a few months later, perhaps, a few months later, or even when it very shortly afterwards, there's usually a recession after this signal. And once there's a recession, the Nasdaq sees a sharp correction. So you can see in 1989, that period, one recession, then with the dot-com bust, and then followed by the GFC. So the main point here is that the inversion can lead to a period of weakness with regards to the Nasdaq. This happens once a recession occurs, but not only when the recession occurs, not when the yield curve inverts. Okay, so next slide, please. So the second point is with regards to the Nasdaq itself at the moment, whether we are entering into a long-term bear market. So long-term as in what happened after the dot-com bust, because the Nasdaq took about 15 years to reach a new high after that bust. So we're just wondering whether that will be a repeat at this moment. So whether the Nasdaq will be in another bear market like the dot-com bust. So if you look at this chart, this chart shows the Nasdaq forward PE ratio, which is an indication of valuation for the Nasdaq index. The purpose of this chart is to see if valuations are at an extreme. Because if valuations are at extreme, we may have a long-term bear market, because if growth starts to taper, valuations will likely compress back to the long-term average. And if it's at more extreme levels, it may take a longer time to do that. So the bear market may be more of a prolonged one. But if you see right now, the forward PE valuation now is 25.9 times. If you look at the right-hand side, So not as expensive as like the .com period, which is as high, it can be as high as 100 times PE. Just that the worry now is because valuations spiked up during the pandemic, because everything went digital, everything went online. So the Nasdaq, there was a valuation premium. You can see on the right side, it went up above the historical average of 23.9 times. And so now, because we are seeing a scaling back of growth due to the economies reopening and there's lesser work from home effect now, the valuation premium might correct back down into the historical average due to this growth slowdown. So we might expect another maybe 10% correction back to the long-term average forward PE, or it may even overshoot a bit if there are any growth scares in the short term. So what we are seeing with regards to valuations, so it may come down a bit to the average, but also we may see some stagnation with regards to valuations. So if you look at the .com bust on the left hand side, after the bust, there was this period of low growth, which didn't see any valuation expansion for many years. So if you look at the arrow there, the post.com, the valuations hovered between around 25 times to about 23 times. It just hovered within that range for many years, about 4 years that time. That's because of the low growth environment. So we think that now there's a risk that we may get that again, because that we may not see any valuation expansion anymore, given that we are in a slower growth environment after spiking up during the pandemic. So what we think will drive share prices moving forward is, what is key to driving share prices is earnings growth. So we won't see any growth with regards to valuation expansion, but more from the earnings growth, which is why the FANGs are can be relatively more attractive because of their strong earnings growth relative to the more of the not yet profit making tech companies in the wider tech market. Okay, next slide. Okay, this is just this is not a new issue. So this has been always ongoing. This antitrust regulation overhang over the big tech companies, because especially in the US and the European Union, they are really scrutinizing on these big tech companies with regards to them being them practicing monopolistic activities. So this is not new, but there was a new legislation that was recently agreed upon in the EU. So the new legislation is called the Digital Markets Act, and this we think mainly affects Apple and Google. So we'll just go through some of the key the key regulations to monitor with regards to this regulation. So the first thing is the App Store. So how it will regulate it, how this act will regulate is that they'll allow alternative payment methods. Because right now, Apple and Google, they mandate people to pay through the App Store or they pay through the Google Play Store, and Apple and Google takes a cut of that spending. So whenever people spend on that, Apple takes about 30% cut of that. Google, I'm not sure how, some percentage cut also. So this regulation will say that Apple and Google will not be able to force people to pay through their platform anymore, so they can actually pay outside. And this is the big thing that will affect the business models of Apple and Google with regards to their app stores. And Apple is estimated to have about 15% of their PATMI, the profits after tax, from the App Store. So this is actually a big big risk to monitor with regards to Apple. It can be a big overhang on Apple to monitor. And the other smaller regulation is with regards to self-preferences on the platform, which mostly affects Google. So with regards to Google, because they are an advertising platform, the regulation states that Google cannot self-preference their own products on their platform. So they can't push out their own product like the Google Pixel above other users on their platform. So this, and in addition to this no self preference, is that for Android devices, they may not be able to regulate what are the pre-installed apps on the Android devices moving forward. So let's say if you buy an Android phone, then usually you get the pre-installed Google Chrome, you get the pre-installed Google Maps, all these Google apps on the Android phone, which Google pre-installs into the phone for you. But this regulation will say that there cannot be any pre-installed apps on the phone itself. So this may actually dampen the competitive advantage of Google's apps moving forward. But this is it's quite uncertain about how much impact this will have on Google itself. What is the main thing to look out for is the App Store alternative payment method. So this Digital Markets Act has already been confirmed, but it still has not passed yet. And after it's passed, it will take about 6 months for it to come into effect. So this is something to monitor with regards to how the big tech companies would appeal this or whether how they can circumvent this. Okay, next slide, please. Okay, so on to our stock picks in this selective environment. So first is for Apple. We still like Apple with regards. The main thesis for Apple is the 5G upgrade super cycle, as everyone from using their 4G devices upgrade to 5G devices, and these 5G devices have higher prices, higher margins for Apple, and because everyone will have to replace their phone from 4G to 5G eventually. So this is it will lead to higher volumes of smartphone sales moving forward for Apple. And also we like Apple for its pricing power because of its strong brand. Just that we worry that growth is slowing for Apple. Firstly, because demand from China may be hit by the lockdowns, and China is about 17% of revenue. The second thing is we're worried of the lack of innovation from Apple, because after the iPhone 13, which is a blockbuster, we just worry that the iPhone 14, which will be more expensive due to the supply chain constraints and the more expensive components, whether they'll have enough innovation to make people want to buy that iPhone 14, or whether there'll be a dampening of demand because of the lack of innovation. So the key thing for Apple, we think, is the balance sheet that will generate the returns, because all this while Apple has been using their balance sheet, their cash, to generate shareholder returns through share buybacks. So if you look at this chart, this is the amount of shares that the Apple buys back every year. And in FY22, they're expected to purchase up to about 82 billion worth of shares, which is about 3% of the market cap. And Apple is expected to generate about 100 billion in free cash flow this year. So about 82 billion of that will go into share buybacks. And so we think this will help to support the share price. And so this will, the balance sheet will likely be the generator of returns. So we maintain a buy, but just that we just think that the stock might move sideways until there may be a news catalyst or new product catalyst. And we're just a bit worried more of the regulation overhang on the App Store. Okay, next slide, please. Okay, this is Amazon. So Amazon is the largest cloud provider in the world, 30% market share. Cloud is like, for those that are not aware what's the cloud, if you use OneDrive for your Microsoft OneDrive, or you use Google Drive, these are the places where you can actually store your data, and also you can get software solutions provided over the internet. Like if you use Microsoft Office 365, you can use your Microsoft Excel through the internet. So you don't have to download the programs. You don't have to, and if companies use the cloud, they don't have to buy data centers to store their data. So for the cloud market, Amazon is the biggest player in the world. And what's driving the growth in the cloud market mostly is due to strategic decisions by corporations to use the cloud so that they can reduce costs and benefit from the available applications like AI, data analytics, and this will help them to remain competitive. So this is driving the cloud is really a big push in strategic decisions by corporations to remain competitive in this market. So the cloud business is growing at about a 21% compounded annual growth rate every year. And so that's why we like Amazon for, is because they are the largest cloud provider and they're benefiting from this big trend. The second trend is, the second thing from Amazon is that they're the largest e-commerce player in the US, 40% market share. This is compared to Walmart, which is about 5%, which is the second biggest. So Amazon is way ahead with regards to the e-commerce in the US. So with regards to e-commerce, Amazon is benefiting from digital advertising on that platform. So the two secular growth that Amazon has is the cloud and digital advertising. But what we worry for Amazon is that the higher costs will linger. So if you look at the chart on the left, this shows the capex that Amazon spent for the past few years. So if you look at FY20, the capex more than tripled during the pandemic. So it rose from about 18 billion to over 60 billion within 2 years, because Amazon had to invest a lot in their fulfillment centers because everyone was buying a lot of things online. And so the result of this will be a higher depreciation moving forward, and one that is still climbing. So the next expense is on the right-hand side on the chart. If you can see this chart, it shows the wage growth in the US, which is at decade highs at about 5%. And Amazon is actually a very labor-intensive company because the core business is in the e-commerce, which involves a lot of fulfillment, a lot of delivery. So they have to hire hundreds and thousands of workers to run this business. So these two costs, the depreciation cost and the labor costs, might be an overhang on the stock, especially with regards to the upcoming results this month. But we still maintain a buy on Amazon. We think that Amazon will be a second half 2022 play, especially because we expect as the supply chain issues abate and also inflation eases, but also because Amazon has the pricing power to increase prices of the fulfillment business on the sellers on their platform. So they actually can pass on the cost of this higher oil prices for delivery and also higher price costs for the wages. They seem to be more willing to pass on the cost over to the consumer and the sellers on their platform at this moment. So we think that it's a second half 2022 play. So for my last company is for Microsoft. Okay, Microsoft, for them, they have a 90% market share in the productivity software market. So your Microsoft Office 365, they have 90% market share in that space of software. And then they are also a 20% market share in the public cloud market, which is just behind Amazon, which is at 30% market share. So Microsoft is also benefiting from this cloud growth. As you can see on the chart on the right-hand side, 24% compounded annual growth rate year on year. So that is one of the growth drivers. And the second growth driver is the productivity side. So these two growth drivers are still growing very strongly. So volume is up for users for the productivity and the cloud side. Volume is up because what's driving the volume is, number one, from the economy reopening. So as the small and medium-sized businesses reopen from the pandemic, a lot of them need to use more of Microsoft Office as they hire more employees. So corporations pay per user for this software. So the more users they hire, the more they have to pay for these products from Microsoft. And for the cloud side, the volume is up because corporations are continuing to digitalize more and more to stay competitive. But not only volume is up, but pricing is also up. So pricing is up because there's this big tailwind from this there was this big tailwind that came in due to some cybersecurity attacks in 2021, and also increased cybersecurity attacks after this Russian invasion on Ukraine. So this is what's causing the prices for Microsoft Office, the licenses to the average spending per user to increase, is because a lot of corporations are upgrading their licenses with Microsoft to enjoy better cybersecurity features in their Microsoft licenses. So this is a very big priority in a lot of corporations with regards to their strategic IT spending at this moment. So this is also driving up prices. So both volume and pricing is increasing. On a 12-month view, we think Microsoft it has the best stock outlook among the FANGs. Because number one, they are software, so they are less impacted from inflation. Number two is because they're not as targeted as Apple, Google, Facebook with regards to regulation. And lastly, because they are more driven by corporate spending rather than consumer spending. So with regards to corporates, it's more of a need when they go into productivity or intelligent cloud to stay competitive, versus when consumer spends, it's more like a want. So we think that corporate demand is more, there's more earnings visibility with regards to corporate demand, as it's more of a strategic decision to stay competitive in this environment. So there's more of a secular corporate demand with regards to Microsoft. So we think that it is a pure beneficiary with regards to secular growth in corporate digitalization. We think that and we think Microsoft has the best outlook with regards to the FANGs. Okay, so I'll pass the time over to Jonathan.
Thanks, Tim. So for Meta, Meta's revenue and PATMI grew about 35% in FY21, with net margins of about 33%. This was mainly due to a strong rebound in digital advertising spend in FY21 compared to FY20 in the midst of the pandemic. However, we do expect revenue growth to slow to a 2-year compound annual growth rate of 15%, especially as the digital ad market growth kind of starts slowing down due to a moderation in online activity, and also due to an increased competition in digital advertising globally. We expect a contraction of PATMI by about 14% this coming year, with net margins decreasing from 33% to 26%. One of the big reasons for this is due to increased competition and also the company's guidance of increasing OPEX and CAPEX spending. And this is mainly to increase their IT capabilities. So they're building more data centers and they're hiring more IT skilled workers to be able to strengthen their tech innovation, and also due to a shift in platform format. So that Meta is actually moving away from, or rather moving to a more short form video centric platform, and it just costs a lot of money to kind of migrate and change the whole platform overall. However, we do expect a slight bounce back in FY23, especially as margins start to stabilize moving forward. So we still have a buy rating and a target price of $312 US. But we are still concerned about, especially for this year, on how the increased competition by other social media websites are weighing down their net margins. Moving on to Netflix. So revenue grew 19% last year, slower than 24% in FY20, and that was largely due to the reason that in FY20 no one could go out, everyone was stuck at home, and so you saw this large influx of subscribers. However, in comparison, PATMI grew 85% last year compared to only 48%. And one of the main reasons for this is you can see in the chart on the left, there's a large jump in net margins from 11% to 17%. And this is due to an increasing operating leverage for Netflix's business. If you guys didn't know, most of Netflix's fixed costs, most of their costs come from fixed costs. So any additional kind of revenue they get just goes straight into their margins. And Netflix's main advantage is actually its strong pricing power, so its ability to raise prices and increase memberships at the same time. And you can see this kind of coming through as they've been raising prices in North America as well as in UK and Ireland. They've been raising it by $1 or €1 or £1 for their standard plans, and about $2 or euros or pounds for their more advanced plans. It's also interesting to note for this chart on the right, ARM is basically the subscription prices per month. So you can see that their ARM is actually almost double, or rather more than double the market average. So it just goes to show that it reinforces the point that Netflix has really strong pricing power and has also been delivering really good quality content that they're actually able to charge this kind of amount and yet grow their users. We do expect a slight dip in net margins for this year, and this is really due to an expected $1 billion loss in foreign exchange due to a strengthening US dollar, mainly because a lot of their revenue comes from outside the US. So, for example, if all their revenue from Asia comes from the different currencies here, and that has to be converted back into US dollar. So the company actually mentioned, or rather they guided to a really significant slowdown in user growth for the first quarter of this year. And that was due to a backloading of content. And also due to reopening headwinds as more and more people kind of get outdoors more as restrictions lift globally. But we expect this to be offset by increases in prices across the board, which has been a key theme over the last couple of years or 1.5 years. They've been slowly increasing prices across different regions, every couple of months. And this is really impactful because, a $1 increase in price just goes straight to their bottom line. It costs them nothing to increase their prices by $1. So we still have a buy rating and a target price of $673. Moving on to my last counter, Alphabet. So overall, revenue grew 41%, which is almost double its 5-year compound annual growth rate. And this is led predominantly by a strong rebound in digital advertising revenue for last year, similar to Facebook, similar to Meta. And the reason for this is because a large portion, about 80% of their total revenue comes from advertising. So in terms of products, YouTube still remains the fastest growing product within the advertising segment, growing at 46% year on year. And meanwhile, cloud remains the fastest growing segment of all, growing at 47% year on year. The biggest reason why cloud has been growing so quickly is because of the quick adoption of hybrid work environments across the world, and also global digitalization trends continuing as tailwinds. One of the key highlights that we see is that PATMI grew 89% year on year, and this was due to a really large increase in margins, in net margins, from 22 to 30%. And this is just because there was significant growth in its high operating leverage businesses across the board. So Google remains a monopoly in many markets, like your Google Search, your Maps, your OS, web browsers, and others. And we do expect stable margins and continuing revenue growth to boost PATMI to 19% 2-year compound annual growth rate moving forward, which is in line with revenue growth as well. We have a buy rating on Alphabet with a target price of $3,493. So in conclusion, we see growth that is slowly tapering off due to the end of the working from home effect and overall slower global growth. We also do see other challenges such as regulatory issues, cost inflation, lack of innovation, and peak valuations as some overhangs to prices or to growth in general. We do prefer Microsoft and Alphabet. Just for Microsoft is basically because it's less consumer centric and more corporate spending. like Tim mentioned earlier. For Alphabet, it's just because their margins are very stable. They have strong cash flow, and earnings have historically been very good. And they have such a large monopoly in many markets that it's difficult for them to start hemorrhaging earnings. So with that, I've concluded with our US big tech strategy. I'll pass my time on to Natalie to follow up with the Singapore REITs Month.
Hi, good morning, everyone. Thank you, Jonathan. Now, I'll be moving on to the Singapore REITs Monthly. Next slide, please. So just to keep track of how the REITs have been performing against the SCI as well as the Real Estate Developer Index. So the REITs in blue here are still currently underperforming the Real Estate Developer Index in green as well as the SCI in red. Okay, next slide, please. In terms of valuations look slightly elevated. In terms of price to NAV, price to NAV is at 1.09 times, which is at the 0.9 standard deviation level, and forward dividend yield at 5.2% is at the negative 1.4 standard deviation level. So valuations are slightly pricey right now. Next slide, please. However, we think that we could potentially see a rally for the REITs. As you can see in the graph on the left-hand side, there is a high inverse correlation between the FTSE REIT index as well as the yield curve. So in the shaded periods, every time you see the narrowing of the yield spread depicted by the blue line going downwards, then we can see also a corresponding increase in REIT prices. Okay. So if this relationship were to hold, then judging by how the yield curve has been flattening in 2022, or rather since 2021, we could potentially see a rally for the REITs. And of course, this is supported by the high interest rate hedge employed, averaging 72%, as well as portfolio rebalancing and rejuvenation efforts by the REITs. And not to mention that because of this, of the slowing growth environment, this may result in a reversal of flows back into stable stocks like the REITs, as growth stocks look less attractive on a risk-adjusted basis. On the right-hand side, we're seeing the same periods highlighted in pink. However, I just want to point out that the red line, which is the two-year bond yield, as well as the green line, which is the Fed rate, we can see that historically they've been trading at about 50 basis points difference or spread. However, at this current juncture, the two-year bond yield is almost 200 basis points above what the Fed rate is, meaning that I think the market has really priced in a lot of this interest rate, the rising of interest rate, especially at the short end of the yield curve. And similarly for the 3-month SOR, the 3-month SOR has also moved ahead of the Fed rate. So all things considered, that could just mean that I think the market will also start to price in. If you look at the euro dollar future market, the spread between the December 2023 and December 2025 contracts has also dropped into the negative territory. That just implies that there might be a Fed rate cut starting in 2023. So that's what the market is pricing in, and then of course is good for the REITs, meaning that moving forward, the interest rate could fall, and that will lower the REITs interest cost of borrowing. Next slide, please. We remain overweight on the S-REITs. Overall, we see that the REITs still have employed a relatively high interest rate hedge, which averages about 72%. So this will help to keep their borrowing costs or borrowing expenses in check. And not to mention the REITs coming in from 2021, they have made almost 13 billion in acquisition. This not only helped to strengthen their portfolios through AEIs and acquisitions, so that just means that they're going into this phase of recovery with even better portfolios, even more resilient portfolios. And we did our sensitivity analysis. 100% basis point increase in interest rates will reduce the FY22 DPU yields, DPUs by about 0.7 to 8.6% on a hedged basis. And if you look at an unhedged basis, it will reduce DPU by 3.7 to 15.4%. And in terms of how our target prices will fare, a 50 basis points increase in our DDM, which stands for Dividend Discount Model Risk-Free Rate Assumption, will reduce the target price by 0.3 to 5%. So overall, I think the impact is still quite, the interest rate impact is still quite contained. Next slide, please. This is our stock recommendation. We are still overweight on the sector. And if you look at our forecasted FY22 DPU versus 2019 DPU, we can see that most of the REITs will actually be, we expect most of the REITs to deliver DPU growth over this two-year period, except of course for some names such as Escort, which is in the hospitality space and still faces a relatively long timeline to recovery. CICT, which they've suffered some negative reversions from their retail portfolio, and of course a recovering retail portfolio still from the returning tourists, and Manulife, which is currently still underperforming due to a higher vacancy in their portfolio, as well as lower other income such as the car park income. Okay, next slide, please. We'll just talk briefly about our of the subsectors which we have data on. First of all, is the retail sector. We are overweight on this sector, and we expect this sector to be uplifted by further relaxation in COVID-19 restrictions. So, in terms of the retail sales value, especially for the last 2 months in 2021, we see that the retail sales value has actually surpassed 2019 levels, and when we look at January 2022 level, is only down by about 1.8% compared to January 2019 levels. So we're pretty much almost back to pre-pandemic levels already. And in terms of the F&B service value, we also see the same thing. Towards the end of 2021, we see a very strong pickup in terms of F&B spend. And at January 2022, this level is down by about 6% from January 2019 levels. And with the recent relaxation in COVID-19 measures announced in March, I think we can expect that this gap will, we can expect the retail sales to trend even more closely or surpass 2019 levels. Okay, so next slide. In terms of the hospitality sector, we still think that the hospitality sector, even though they have the RevPARs have increased significantly, we can see that February 2022 RevPAR levels is about 77% higher year on year, and this is of course on the back of improving occupancy. Occupancy improved from 45% to about 42%. So it's a very, very great improvement in occupancy, as well as average daily room rate, which increased by about 27% year on year. Yeah, but of course, this is still quite a long way more to go. We are still about 41% below February 2019 levels. And in terms of RevPAR recovery, we think that RevPAR recovery will likely come rather back to 2019 levels, will likely happen in 2024. So it's still relatively long timeline to recovery. And in terms of international visitor arrivals, IVA, this is the chart on the right hand side. The red color columns is still about 43%. It's only 4.3% of the 2019 monthly average. So meaning to say that we are still very, very, very far behind in terms of IVA. So overall, we're still neutral on the hospitality sector. We think that sectors such as the retail as well as the industrial subsectors, the return potential the total return potential is higher compared to hospitality. So while we still expect hospitality to be a recovery play, we think that other sectors look more attractive. So that's about it for me. I'll now hand the time over to Vivian.
Thanks, Natalie. So we hosted G.H.Y for a poems webinar last week, and this will be a short summary of what we covered in the webinar. And just a note, we do not have coverage on the counter. So G.H.Y has two main segments. Firstly, the TV program and film production, which makes up 91% of FY21 revenue. And the second one would be costumes, props, makeup, and talent management services, contributing 9% to total revenue. On the FY21 results, revenue fell by 34%, while PATMI fell 90% to $3.9 million. And this could be mainly attributed to the delay of production schedules or even postponement, including this drama called Sisterhood, which they shifted from China to Malaysia during the height of the pandemic. And even when they managed to resume filming, they had to incur costs to ensure that COVID measures were properly implemented, including the testing for their staff. So in FY21, they completed the filming of 3 new dramas. And for G.H.Y, they are able to take care of the whole end-to-end production process, from the script writing to filming to post-production. And hence, according to the management, they enjoy higher margins than their peers. Referring to the business models on the right, under TV program and film production, there are 3 main revenue models. Firstly, the company could be engaged by a customer for production for a fixed fee. So for example, Netflix or your Chinese players like Youku could provide G.H.Y with a story. So the IP is not owned by the company, and GP margins would range from 15 to 30%. For models 2A and 2B, the whole production is by G.H.Y, then sold or licensed to the customer. So the IP is owned by G.H.Y, and hence margins could be higher at around 25 to 60%. And this model 2 contributes about 70% to the total revenue. On the last revenue model for TV program and film production, Model 3, it consists mainly of mostly smaller scale productions, like producing short form videos or dramas on Douyin, which is a Chinese version of TikTok, and G.H.Y would charge variable fees based on the viewership. Currently, this Model 3 only contributes about 5 to 10% of the total revenue, but is expected to increase due to consumer pattern shifting towards watching more of these short form videos and dramas. So G.H.Y is also expanding their entertainment product offerings to include musicals, which they already produced one under this joint venture with iQIYI, another Chinese online streaming platform. The concert production revenue was totally absent in FY21, but is expected to return beginning 4Q22, including this would begin with J.H.Y's Carnival concert in Singapore to be held at the end of this year, as you may have seen in the news. And there is also there would also be subsequent concerts resuming in Malaysia and Australia in first Q of 2023, and also more to follow in other Asian markets and also for other artists as the world returns to normalcy. The concert revenue could contribute about 30% to total revenue as seen in the first half 20 numbers. So this could be another revenue driver. And for the concert production, they mainly collect the proceeds from the concert ticket sales and also sponsorship income for concert organization and fees for concert management. The next one would be on costumes, props, and makeup. So under this segment, they provide these services for their own dramas. And other than that, they also do for major events, like collaborating with this award-winning designer to provide services for performers in the Beijing 2022 Winter Olympics opening ceremony. The last one would be on talent management, under which they manage their own artists. So in FY21, they established this joint venture company with iQIYI called Uni Icon Entertainment to expand in talent management in the Southeast Asian region. In conclusion, for this, for G.H.Y, moving forward, we are expecting more productions under TV program and film production in 2022, and also concert revenue to come back. So that's all for G.H.Y. I'll now be passing the time on to Paul for Singapore Weekly.
Yeah, thanks, Vivian. Next slide. I'll just run through some of the macro highlights that were released last week. We have the MAS monetary policy statement. So they raised their core CPI forecast, which is their inflation forecast, and said that the economy is growing above trend. So as a result of this, they are making a very aggressive move to tighten monetary policy, which is basically raise the exchange rate. So they are recentering the midpoint, which in layman terms means that they are gapping up the Singapore exchange rate, and they are also increasing again the rate of appreciation. They already started raising the rate of appreciation since October of 2021. We had some healthcare stats. The numbers isn't good. So year to date, February, which includes the festive period, is down 7% for hospitals and down 13% for dental. Construction remains robust. Construction contracts awarded for year to date February, which means we combine Jan and Feb to remove the festive period, is up almost 50%. Most of the construction awards coming into Singapore is mainly from the public sector, which doubled to almost 4 billion in the first 2 months. In terms of land transport stats, the rail traffic, which will affect Comfort and also SBS, remains weak. So it's down 3% March, and for the first quarter 22 is down 4%. So you won't expect any recovery in first quarter transport stats since the key reopening only happened in late March. In terms of the US, there was some retail sales. So retail sales in the US remains robust. But of course, we got to take it sometimes with a pinch of salt because inflation is also at the same time 8%. So it's still record high and robust. Pre-pandemic, retail sales used to grow maybe 4 to 5%. So right now, it's growing double the rate of 9%. Inflation, I think we all seen this is record high. Initially, before the Ukraine conflict, we expected maybe March inflation to kind of taper down because we're doing year on year. So we're comparing, to March of last year. But last year in the US, the inflation only started to pick up in April. So we were expecting maybe April 22, May 22, maybe could be softer. But with the fuel price hike right now, I think you should still expect very high numbers. Hopefully in the fourth quarter or late fourth quarter, will we see inflation start to slow down a little bit, at least on a year-on-year basis, because the prior years were already so high. Some global numbers. So we had some exports from Korea and Taiwan. So exports from both these countries remain very robust. It's like 18, 20%. So these are really strong numbers. Tactically, I think we still expect market to more likely move sideways because there's still no change in this stagflation trend, which is like rising inflation and slowing growth. And in terms of the US banks, I mean, we don't cover it, but because we have an overweight on Singapore banks, we will just run through a little bit on the US banks. But so far, the results, it does not affect our view on the Singapore banks. It is more investment banking in the US and also some normalization of their provisioning, but we'll explain later on the future slides. In terms of the events for this week, the main one will be some of the big tech or big tech stocks releasing their earnings, namely like Netflix and even Tesla. We have, I think, 3 webinars for this week. We have BSG, The Place, and also TDCX, which is actually a Singapore company listed on the New York Stock Exchange. Next slide. So in terms of our view, so the red line is basically CPI, but this is core CPI. It means it removes all price, and this red line tends to be a bit more steadier. It's not such a volatile number, and it's a bit troublesome because you can see that the red line, which is inflation, is so much higher than interest rates. So there's still a lot more room for interest rates to climb. I'm referring to the 10-year bond yield. So won't be surprised even if the 10-year bond yield hit 3%. Right now it's about 2.8. Next slide. Okay, this is always the noisiest slide we show for the Singapore exchange rate. So the red line is the NEER, which the MAS always release. So this is basically the Singapore exchange rate on a trade weighted compared to Malaysia, China, all our trading partners. The red line is the US dollar. So if it goes up, of course means Sing dollar is stronger. So you can see that even though we had increased slightly, that means the Singapore MAS always has increased slightly the rate of appreciation. You can see that the US dollar, the red line, hardly moves, probably range bound. So we don't see any change right now. So although the MES is tightening very aggressively, which is the blue bar which is re-centered upwards, means you gap up the exchange rate, right? So that rarely happens. The last time is 2010, 2011, when the economy was growing so robust after the global financial crisis. So we are facing this time now, but we still don't think, it doesn't mean that against the US dollar, the Sing dollar were going to rise very strongly. We only had that in 2003 to 2009. No, that was when Singapore was growing much, much stronger. So we, although it's a very aggressive move, so don't expect the Sing US dollar to strengthen that much. Next slide. So this is just again, this is just a snapshot of so far how has Singapore exchange rate performed compared to all the major currencies. So we are losing out to some of to Australian dollar and also US dollar. In rate means it's negative. It's a bit counterintuitive because this comes from Bloomberg, but where we are appreciating is mainly the developed countries against the yen, against Taiwan dollar and the euro. Of course, the Taiwan dollar might have a little bit of impact on the Asian pay TV. It won't affect the dividends, but maybe the headline numbers might be a bit affected. Next slide. So this is just to show the construction. So the blue line is the amount of contracts awarded on the 12 months. So if you look at BCA forecast, so BCA is looking at 25 to 32. So if you assume 30 billion up to 2023, so this is quite a impressive forecast. It means that this blue line will not drop down. It would continue to linger around these levels for the next 4 years, which gives us at least almost a 4-year visibility of the amount of that construction activity will remain robust. If you look at this chart, it can usually hover to almost to the lows of 20 billion. But BCA forecasts tend to be quite accurate. So you can expect construction activity to remain elevated up to even 2026. In terms of the chart on the right, it just shows healthcare volumes is kind of decelerated up. Because maybe the last year was exceptionally strong, so this year just slowing down on a year-on-year basis. But you can see that the blue line, which is public hospitals, continue to outperform private. I guess because there's just so many public hospitals these days compared to in the past. Next slide. Okay, this is just a snapshot of the US banks, how they perform. You got JP Morgan, Citigroup, Goldman. Of course, there's many more. I'm just taking a few. We don't cover them. But if you look at the very last line, so we were initially quite worried. We thought that the banks in the US dropped almost 40%. You can see the earnings, everything dropped 40, Wells Fargo 20. But most of it comes from investment banking. If you look at the red box in the middle, so JP Morgan's investment banking are down 30, of course Goldman 40. So most of it is because a year ago they made a lot of fee income from IPOs and also from all the SPAC listings. So this won't really affect Singapore banks since our IPO market is dead. So maybe it's less dead now, so it doesn't really make a difference. The other one is provisions. So for JP Morgan, if you just take a look, there was a 5 billion swing in provisions. And you look at their profit is only 8 billion. So that 5 billion swing make all the difference why the earnings drop about 40%. But it wasn't because bad debts in the US was climbing so high. It was just that a year ago, they had a lot of write-backs. So I think they had like a positive, I think 4 billion of write-backs or more. So right now it's back to normalizing. That's why you see this big swing. So it doesn't mean that the bad debts in the US is collapsing. It's just there's a bit of Ukraine effect. They were just going back to normal because a year ago they had the positive provisions, which is cannot be. It's unheard of. Not provisions supposed to be negative. So because there are a lot of write-backs. So likewise you had for Citigroup. So for us, we were more interested in the net interest income. I mean, just to compare to Singapore banks. So that is still growing, and that's the main story for Singapore banks. Is mainly going to be the net interest income, which is the higher margins and so forth. So we just wanted to have a quick look at the US banks just to see that whether it will affect the sentiment in Singapore. So it's a bit more isolated in US, or the 40% decline in earnings. Next slide. So this is my last slide on the SPH. I'm just preempting anyone asking us. So in March, I think 22nd March, they've already mentioned that the shareholders have approved the takeover offer by Cascaden. So right now it's up to shareholders to choose whether they want the cash, which is on the far right, the $2.36, or they want the cash and shares. which is cash 162 and shares. The cash and shares that you see here, the 0.782, that is automatic. So if you don't opt for it, you will. If you don't opt for the cash, which is the 236, you are going to get this 162 and 0.78. So if you do the numbers roughly, the cash offer looks better because the cash offer you are getting 236 versus the cash and shares, which is about $2.33. Again, it's optional. I mean, it's only a 1% difference, but again, that 0.733 that you get from SPH REIT depends whether there's a takeover offer and so forth. So just one last point. Again, this is just for in case anybody wants to know. You don't know, it's also fine. But because SPH owns 66% of SPH REIT, you can see on the far right of the table the 66. So if every shareholder say I would just want cash, that means SPH will be stuck with 66% of SPH REIT, and then they have to make a general offer. So of course, if more people take, then you go to keep on going to the left. If everyone takes the shares, then SPH doesn't own any SPH REIT, then they don't have to take offer. That's why you see the word the MGO triggered no. Okay, so as a result of this, they will just own like 20% and below the 30% threshold. Okay, I mean, this is just for reference. I think in case anyone doesn't have the SPH, it doesn't really apply to you. But again, this is just, I guess, good to understand too if you have something similar to this in the future. Since there's so many privatization on the SGX. Okay, next slide. Okay, thanks everyone. We can go to Q&A. Okay, let me just take this question first before we hand it over to the US team, because I saw this question early. Okay, so the question here is which is an interesting question. Like Singapore O&G cash offer of 295. The deadline is today. What happened after it hits 90% share acceptance? What happens if it did not hit more than 90% acceptance end of today? If I did not accept the offer after the offer deadline, what is my status? Can I still sell my shares? So just a bit of background for those who do not follow. So Singapore O&G had a cash takeover offer of 295. So of course, if it crosses 90%, then it's a compulsory acquisition. That means whether you like it, don't like it, they can forcefully, okay, the nicer word is compulsory acquire your shares. But the latest announcement, they did not cross the 90. So what happens? One likely thing is that they might extend the offer. If you look at the GL Limited, the Guoco Leisure, they call it GL. If you follow the GL kind of offer, they didn't get the 90%, so they extended the offer by 2 weeks. Then the GL offer was that after 2 weeks or so, nobody cared about their 70 cents offer. So as a result, they went into the market and buy, and they revised the offer higher to 80 cents. For SOG, I don't think so because they're quite close to 90. They're like almost 88, 89. So they might, most likely, I think they will extend the offer another 2 weeks, the 29.5 cents. If they still cannot get, they can either extend, they can either raise the offer because they didn't say 29.5 cents is the final offer price. Or they could just leave it like this, which I don't think so. I mean, they probably want to privatize it. So that could be the scenario. They'll extend it or they might raise it. Again, I have no idea. I mean, I'm just saying these are the two possible options. I'm not sure which is likelier. So if I did not accept the offer after the offer deadline, what's my status? So they will extend it, and then I think if they extend, they will lift up the trading suspension. You will still trade. Then I think if you suddenly see the share price jump up, maybe the offerer went into the market and beat up the price, and assuming they say they go to the market and buy the shares at 30 cents, that means they have to offer everyone at 30 cents. So that is what, yeah, you can still sell your shares. I mean, but the worst case is if they don't take the offer and they just leave it like this, then you'll be like stuck because then it will just languish like that. You can trade the stock, but there'll be no volume and all that. But I don't think so because it's not such a large company. I think raising the offer should not be such a big issue. Again, I'm not sure. I'm just guessing here. And I hope that helps. Yeah, I think I hand it to the right.
Okay, there is a question. Will Apple and Microsoft be affected by the backlash of pulling out of Russia, meaning some other countries may now be hesitant to tie up with American companies, for example, China. I think with regards to backlash, I think there is more backlash if Apple and Microsoft chooses to stay in Russia. So with regards to whether China will boycott these Apple and Microsoft, I think it's unlikely because there will be some backlash onto China itself if they side with Russia. And so that's why they have to play this balancing act. But with regards to Apple and Microsoft exposure to Russia itself, I think they are quite safe with regards to their exposure. So Apple has about 1% revenue exposure to Russia. Microsoft is 0%. So they're not really, both of them are not really exposed to Russia. Are quite safe lah, in a way. The next question, are Microsoft and Alphabet going in for stock split? If yes, what is the expected effect of such an exercise? With regards to stock split, Amazon recently announced one, I think a couple of months back, and the share price reacted quite positively for their 20-for-1 stock split. So because it increases the accessibility to retail investors, it's cheaper at the stock price. So I think the share price will react positively for Microsoft and also Alphabet also. Next question, if we do have a bear market like the dot-com bust, what would be a good course of action for investors to take? And those of your US stock picks. Okay, for the bear market, what we mean is in terms of valuations. So we think that there may not be any valuation expansion for a while because of the slowing growth. So we expect earnings growth to be the main driver of share prices moving forward. So what we favor within the FANGs is those stocks that have more earnings visibility, which is what we prefer is Microsoft, because number one, they are software, so they're less affected by inflation. Number two is because they have less regulatory uncertainty because they're less targeted as compared to Apple or Facebook or Google. And the last thing is because of corporate spending, because it has higher earnings visibility because corporations need to spend on the cloud and also for their productivity software especially at this point in time, is because they need to remain competitive. Whereas if you are more reliant on consumer spending, I think that there's a bit more uncertainty there because of higher inflation. So we think that's why we favor Microsoft at the moment, because of the better earnings visibility. Okay, I think that's all for us. Thanks.
Natalie or Glenn?
I can take the. Okay. So there's one question. I think Paul answered it, but I can just go into a bit more detail. The question was US banks profits down 30 to 50% in Q1. How do you compare Singapore and US bank situations? And do you see the Singapore banks profits to decrease as much in coming quarters? So could we go back to the slide with the US banks, if possible? Yeah, so I think Paul mentioned earlier that the US banks, the decrease in their PATMI was mainly due to the drop in investment banking, as well as their provisions change. So do we see Singapore banks profit decrease as much? No, we don't. Firstly, because the investment banking, they won't drop so much. We don't really have it here. As well as the provisions, all three banks have mentioned that their provisionings will be maintained at the same levels. So we won't really see this decrease. And if you can see, the net interest income has increased for all the US banks. So the Singaporean banks have also mentioned that they would expect their net interest income to increase as much. And also their fee income. So the fee income and net interest income increasing, we won't see this much of a decrease. Actually, I don't think we expect a decrease. Okay, there's one more question. It said that stagflation will affect banks negatively. Sorry. How do you see the Singapore banks going forward? Will you still be recommending buying Singapore banks? And which ones would you prefer? Okay, so there's a follow-up to this question. You said nothing wrong with the banks. Consensus OW banks, but overweight on the banks, but the price action speaks for itself. So for the banks, yes, we will still recommend buying Singapore banks. And how do we see the banks going forward? The main factors affecting banks would be, of course, the NIMs. So the increasing interest rates, this would positively affect their NIMs. So we will see their NIMs increase, and this would increase their net interest income, and then overall they'll increase their PATMI. And the second one would be that we expect that this is a benign provisioning cycle. So their credit costs have been lowered. So they have projected for lowered credit costs. DBS is the one that has projected for credit costs lower than pre-pandemic levels, whereas the other two banks, UOB and OCBC, have mentioned that their credit cost is relatively the same, slightly lower, I would say, not really lower than pre-pandemic levels, but definitely lower. So what is which ones do you prefer? So we would, our preferred pick will be OCBC, and this is due to their attractive valuations as well as the upside in the dividend from their 15% CET1 buffer. So their CET1 is the highest amongst all three banks. The other two banks, they both have bought over Citigroup's assets, so their CET1 definitely lowered a little bit, but OCBC has not yet openly acquired anything, so their CET1 is 15.5%, if I'm not wrong. So this is the highest among all three banks. And we also expect lower provisioning for OCBC as the Indonesian and Malaysian economies recover. So what affected them the most in the fourth quarter would be the increased NPLs in Malaysia and Indonesia, as well as the increased SPs in China. So if we were to expect that the Malaysian and Indonesian economies are to recover, this would sort of pull back their PATMI, and as this was the only thing bringing them down last year in the fourth quarter. Yeah, so I think I've answered all the questions for the banks. Okay, I'll hand it over to Natalie. Thanks.
Thank you, Glenn. All right, thank you, Glenn. Okay, I'll take some questions for me. Okay, so two questions about Singapore property sector, CDL versus UOL versus CLI versus CDL, 25-week high, and UOB is the laggard. Okay, so what's your best buy among the three? And why did the sale of Tong Sing's two core central region projects get hit hard by cooling measures, as reported in Business Times today? Is it is a good read through into the sector. It doesn't augur well for developers like CDL, UOL. Thank you. Okay, so for the first part of the question, just want to qualify my response by saying that we only cover CDL and CLI. We don't cover UOL. So our understanding of UOL is less compared to the two that we do cover. That being said, CLI and CDL, of course, they have recently experienced very strong share performance recovery in the last 2 months. And that being said, CLI has actually already hit our target price of $4.05, or it's hovering around there. And CDL has there's still upside to our target price for CDL. Okay, so for UOL, I believe that their share price has not recovered as strongly as the CLI and CDL. I think that has much to do with for UOL, they have a smaller inventory size. Okay, sorry, let me just address the question about the property sector first. Okay, for the property sector, yeah, one second. Okay. So for the property sector, I think there's no surprise. The cooling measures that were announced in December, that was largely through the higher ABSD, additional buyer's stamp duty. That of course will have a cooling effect, and also a wait and see. It will wait and see response from most buyers. That being said, we saw that the new home prices, the new home volumes moved for new property launches actually fell by 50% over the 3-month period, meaning January to March, new home sales fell by 50% compared to the same period last year. And also I think resale transactions, they were down by about 37% for the same period, over the same period last year, compared to last year. And I think this is still very much due to the wait and see on trying to understand the impact of these cooling measures and seeing how the property market will actually react to it. And we do expect that this softer sentiment for the property sector, for the buyer sentiment, to last for maybe another quarter or quarter and a half. And yes, we do think that the reopening of the borders, that might actually help more foreign buyers come, allow them to come back to Singapore to view the properties and also to purchase more confidently. Another thing to note is, we've spoken to some of the developers, and they've shared with us that some of the foreign buyers, these are more cash-rich buyers per se, so they are not, to them, I think the increase in ABSD to them is not really much of a big deal, so they don't really expect much impact from that, but there will be a wait and see impact. Yeah. Okay, another thing to note about CDL versus UOL. So CDL has a larger inventory of residential sales, or rather the pipeline of home sales homes for them to sell, versus UOL, which they have a little bit light on inventory. So CDL has about 2,000 to 3,000 units, depending on how well they've sold in January to March, versus UOL, I think theirs is only about 1,000 or maybe less than that. Yeah, okay, around 1,000. I'm not too sure about that. And in terms of, in general, the whole market is a little bit softer, especially for the first 3 months this year. But do note that for CDL, some of their properties, some of the assets that they have in their inventory, that includes like Liang Court, which is a joint venture between CDL as well as CLD, Capital Land Development, and their redevelopment of Fuji Xerox. Some of these projects, they have very low or comparatively low land costs, because Fuji Xerox is a redevelopment. They have had this asset on their books for the longest time, and they bought it 20 years ago at way lower prices, and they did a redevelopment that allowed them to unlock GFA, meaning they have more land to more space to rent, more space to sell, meaning to say that helps them have better margins on the project. Similarly for Liang Court, where they actually did an off-market purchase, meaning that the land cost is slightly lower, and therefore affords them a slightly higher margin. And these two examples, right? They are a very unique location. Property, you can't really find another residential asset that is at the edge of Clarke Quay. Yeah, so I guess that really also helps with the demand and the result of why they have sold so well, last year, and they're actually capturing the property highs. Capturing the sales at the high of the property market. And so I think that answers the question. And for CDL, they also do have a lot of upside in terms of like the hotel portfolio that they have is larger than UOL. I think so I guess that is where some of the upside, there will be more upside from the recovery of the property sector due to CDL's relatively larger exposure compared to UOL. Okay, so just very quickly on CLI. So CLI, they are not really property developers anymore, although they're still playing in the property field. They are more of like they're trying to grow more of their recurring income through the fund management, private as well as the listed funds, which are your REITs. And so I think as I mentioned earlier, the target price has already hit our, the share price has already hit our target price. So at the moment, the share price will be under review until we come up with a new share price. But then I think all is quite optimistic for CLI. They have been very aggressively trying to grow their private funds. Yeah. So we'll probably give an update, in the coming few weeks. Yeah, I think that answers the question. Yeah. Okay. So overall, our outlook for developers is we're still overweight. I think, but we have lowered our new home sales expectations from 10 to 12,000 units in 2022. We have lowered it to 8 to 10,000 units, and we've maintained our price expectation of 0 to 5% growth in 2021. Yeah. So the developers, those that have stock, are still expected to capture, nice profits. And of course, those with more inventory, they don't really have to bid so aggressively to get new inventory to sell. And that's where we think CDL stands out, because they already do have a relatively cushy pipeline. So they don't have to really go out there and bid very, very aggressively. And they're still able to, get some of the off market deals, like their recent, or not so recent already, just at the end of 2021, their Upper Bukit Timah land sale purchase, that was an off-market purchase from, I think, Tai Seng Motors. Yeah. So through these kind of initiatives, redevelopments, and yeah, they are able to sort of capture a higher margin that will help them. Yeah. There's a separate question actually for correlation between the developer index and the yield curve. And the yield curve. Okay, so the answer is, for the developers, they don't really have a very strong correlation with the yield curve. So the correlation we are calculating based on weekly share price over a period of 5 and 10 years, and based on the correlation. So the correlation number goes like -1 to 1. So if it's -1, it means it's a perfectly inverse correlation. Every time the yield curve narrows, then we should expect increase in share price. So that's if it's perfectly inversely correlated. And if it's zero correlation, it means that there's really not much of a pattern that we're seeing, not meaningful. And then of course, +1 would be, +1 would be they move in tandem perfectly. But in reality, I think that there's very, very few factors that actually perfectly correlated. There's high correlation. So for the REITs, there's high correlation, between 0.5 to 0.7. Whereas for real estate developer, there isn't really that strong a correlation, about 0.5, 0.4, 0.5. But negative. Sorry. Let me repeat this. For the REIT index, is a -0.5 to -0.7 correlation, meaning it's inverse and it's relatively strongly negatively correlated. For your REIT index is -0.2. Yeah, so that is a lot. It's not really exhibiting a very strong correlation or inverse correlation with the yield curve. It exhibits a stronger correlation with the long-term 10-year yields, and the correlation with the 10-year yields as well as the short rate, which is the 3-month SOR, is about 0.4. Yeah. So I hope that helps. Okay. Okay, there's another question here. What's your view on capital DC versus digital core, and which one is a better bet for long run? Okay. We don't cover digital core. Sorry, let me just answer this question. We don't really cover digital core. And for capital DC, just judging by how by their share for at least for 2021, I think it is a relatively good opportunity because of their share price has actually been under pressure for quite a long time, but yet so I mean the yields for a data center REIT is actually comparatively attractive. It's currently now about 4.3% thereabouts, which is something that we have not seen for KDC for I think the last 3 years even. For digital core, one thing that they have to their benefit is their acquisition pipeline, or rather the ROFO pipeline. So that will of course help them with their inorganic growth in the longer term, because they have about, I think, 10 billion worth of data centers for them to acquire. Yeah. And for Capital DC, I mean, they have done a very good job in the past 3 years, in terms of maximizing their space, unlocking value for their space, bringing on more power so that they can lease out more space, as well as AEIs, and they've really done, and their double-digit kind of DPU growth is largely attributed to these initiatives, but also of course they've managed to pick up a few assets. Moving forward, I think their portfolio has been maximized to its full potential, so growth will have to come from inorganic sources. And if you look at both REITs, they need to grow inorganically, I think, because of digital core's ROFO pipeline. I think that really greatly gives them an advantage in terms of inorganic growth. So for a longer play, perhaps digital core might provide a longer runway. Yeah. But that being said, we don't cover digital core. And for Capital DC, presently the FY22 DPU yield is about 4.7%. So it's really never seen before for a DC REIT. And also the fact that in terms of total returns to our target price is about 30% upside. Of course, I do need to mention that I think there's another headwind for Capital DC, which is the lifting of the data center moratorium. That means that the supply of data centers in Singapore could potentially increase, although it's only 3 data centers, I think, per year, or a relatively small amount of megawatts that the government is releasing, but that will increase I think it's 30 megawatts. So okay, relatively substantial, but that will increase the data center supply, and that might actually cause weaker reversions for Capital DC. And I think for Capital DC, they've always their stance is always they are more conservative REIT, meaning that they try to veer away from doing any new development kind of assets. So I think they probably might not be too actively bidding for any of the data center sites. So that is one of the headwinds for Capital DC. But nonetheless, I think it's quite, for these deals, I think it's quite attractive for Capital DC. Okay, I'll hand the time over to the rest of my colleagues to try to touch a broader base of questions before I take back the mic.
Hello, Vivian here. Yeah, sorry, Paul. Maybe I'll cover the question on LHN Logistics IPO first. So what is your take on these IPO? I guess in general, very positive on this. I think both for the LHN, we have coverage on LHN with a buy rating and a target price of 49 cents. So on both LHN and the logistics business, as you may know or may not know, for LHN, they have quite a few different business segments. With this IPO, I guess it's positive for them in the sense that they are able to place more focus, and maybe investors would be clearer on their direction for LHN, which would be on the industrial and the residential properties. So for the co-living, co-liu properties, and also work plus store, which have both been seeing full occupancies due to the co-living trend and also rise in e-commerce. So for the LHN Logistics, maybe a bit more picture on what they do under this logistics business. So there are 2 sub-segments under this. Firstly, you have the container depot, whereby they operate the container depots, I think currently in Singapore and Thailand, and they are I think commencing operations for one that they acquired in Myanmar. So basically, when the containers arrive in Singapore, they would be the company to wash and part of the few companies, I guess, to wash and inspect and also check for areas to repair or anything, basically to prepare the container for the next trip. So that is what they do under the container depot. Second one would be on transportation. So they own this fleet of vehicles, including trailers, to transport dangerous chemicals. One is within Singapore, another one within Malaysia, and they also do cross-border trucking. So under the IPO, I think in the preliminary offer document issued, they did mention on expanding the fleet of prime movers and trailers to expand this transportation segment. So moving forward, I guess for container depot, it has been strong throughout the pandemic, mainly due to the higher volumes of containers, the throughput, and even after, I guess, supply chain issues ease, there would of course be continued logistics demand. And for transportation would be benefiting from the growth prospects for Singapore as a chemical industry, and also Singapore's status as the transshipment hub, which would be benefiting the transportation sub-segment that they have under logistics. So I think we would be giving a more detailed maybe presentation on this IPO when they release the final offer document with more details, including the valuations and all. Yep. Pass the time back to you, Paul.
Oh yeah, thanks, Vivian. Let me just try to answer some of this. Hi, Philip. Which sectors do you think STI will benefit the most from a sector rotation out of banks? Is that conglomerates, property, aviation, or consumer? Thank you. Okay, this is a bit difficult to answer, but assuming you are rotating out of banks because you think interest rates are already toppish and interest rates might come down because there's going to be a huge slowdown. So one candidate would be conglomerates, because Keppel, Sembcorp, and Keppel and Sembcorp are mainly utilities now, so that's a bit more defensive. And of course, you have ST Engineering as part of the conglomerates, because ST Engineering is very boring, but of course that's what you want. You want to buy boring stocks because you think rates will have peaked, coming down, and global growth is slowing. So that will be one way to rotate out. And alternatively will also be REITs if you have this scenario. Another reason to rotate out of banks would be if you think the reopening has one more leg, which is international borders normalizing. Then, as you put it in the question, then one would go into the aviation sector. So I think those would be the two sectors. There's either conglomerates and aviation. It depends how you view. For me, it would be a bit more on the aviation, because I just think that I don't think we're going to have a huge collapse in global growth. So that is our base case. The next question is, Paul, what's your view on PropNex and APAC Realty in the next 3 to 6 months? I think it will be sluggish. You can see the next 6 months transaction volumes will be at best, I think down 20-30% at best. At worst could be much lower, but we think at least the 20-30%. So the results won't do well. So it's very hard for the share price to move, unless there could be other events. Maybe assuming there's consolidation in the industry or huge market share gains. Apart from that, I think these stocks will be at best will be more like range bound, because you're not getting the volumes that can help drive earnings. And then without earnings, in the Singapore market, can't really help. It will be hard to push the share prices, but they will continue to pay attractive dividends. And my guess is maybe at least 5 to 6% for PropNex, because we only cover PropNex because they got a lot of cash, and they always wanted to make this a dividend yielding stock. So because of both of this, you might just see it maybe range bound, but earnings will drop significantly because the volumes are down. Okay, let me try to answer this before I move on to Natalie. Hi Paul, where are we now in stock market cycle? Are we in the market top or early bear stage? Which sectors would do well in the current market cycle? Are we moving on to the next stage of cycle soon? I think we are a bit at the late stage, especially for the US. For Singapore, it's hard to call late, because if you look at the STI, we hardly move after 5 years. I think if you look at the 5-year chart, we've been up, down, we're back to square one. So we think there's a good chance we think maybe the Singapore market can at least break the new high if the rates climb and we don't have a collapse in global growth. But it is definitely late stage. So it will be more like a very range-bound market, like was highlighted by Timothy for the US market. Singapore a bit different because we have other growth drivers, other earnings growth drivers, which maybe the US may not have because the valuations are elevated. Yeah, from the lows to the highs, I think the US has already doubled in the last, I don't know, 2.5 years from the lows in year 2000. So yeah, I think at most you'll be just like trading sideways or just consolidating. But you can in general just classify it as late stage because economic growth is late stage now. That's why the Fed has to raise rates. If I have to tag a cycle to it. Natalie, you want to do the next one? Okay. Next one is your prognosis for Wells Fargo, PayPal, Pfizer. Yeah, sorry, we don't cover this. Our US analyst team is mainly on tech sector. Because the US is just too huge, so we're not going to like cover every sector in the US, but it's mainly tech stocks for now. Some indication that China intends to lower rates, which is completely opposite what the West is doing. Yes. So because China's inflation is only 1.5%. Because a lot of it is hog prices, so food prices collapsing. I think hog prices is down, I think 40% year on year. Maybe and that's why Wilma is affected because of the weaker hog prices. Yeah, it's opposite of the West because I think China is worried about the slowdown because of all the lockdowns. So they recently reduced their reserve requirement. So reserve requirement, for those who don't know, is every bank in China, even in Singapore, they have to put some money in with the central bank compulsory. Ours here maybe 1 or 2%, but in China it used to be 20%, now it dropped to 8%. So I think China is worried about growth, so that's why they kind of lower their interest rates there. Yeah. To prop up, because you can see the property prices also coming down. So China is more like lowering rates because they want to prop up the economy. Yeah, I hope that helps.
Yeah. Hi. Okay, so I'll take the next question. Is real estate an inflation hedge asset? If yes, why would real estate developers' share price seem to perform better than REITs sector since both sectors hold real estate assets and are leveraged? Okay, so I think the theory is that yes, there is some inflation hedge for real estate in general. I think, and also the reason why the real estate developers seem to be performing better at this leg, I think, is because the share prices have actually been relatively sideways for real estate developers. So that this part of the recovery, it seems that it is stronger, but it's because they have been trading sideways. So the pickup is greater compared to some of the REITs. Some of the REITs, they actually experience share price recovery as early as June 2020, and that was like more for your industrials, and that I guess that's why, because already comparatively they're already recovered, so whatever else, the upside is smaller compared to when you're looking from a lower base, which is where the real estate developers are at. And if you look at it, the real estate developers are still currently about 15 to 20% below pre-pandemic levels. And it really depends on the assets that they're holding also. For your homes, your new home sales, your residential right now, we're experiencing a property high. So that means that, whatever inventory that they had existing from 2019, 2018, 19, 20, they are now able to capture, even greater profits or even greater margins than they, probably have forecasted in their budgeting. So of course, I think that helps the real estate developers, and they also do have some assets in, depending on the company, their proportion between like your commercial and hospitality assets, the breakdown. So I think that also sort of accounts for the different kind of performance, the varied performance between the developers. And as for, yeah, so I think that answers the question. Really, I think it depends on which part you're measuring. So of course, just now initially I showed you guys the STI, real estate developers versus the STI versus the REITs, and we are underperforming. I think, and this leg of the pickup, a lot of it is also related to the CLI, which is sort of no longer really a real estate developer, but I think it's still classified within that category, even though now they are like a realm, which is real estate investment management. Yeah. Okay. I think another question, which is why just general target price and view on CICT, which is Capitaland Integrated Commercial Trust. So our target price for CICT is $2.39. Yeah, and I think overall for CICT, what we're seeing for them is, okay, first of all, we know that they have a portfolio of, a grade A kind of office assets. So the grade A office, I think the occupancy has come down slightly, maybe about 2 percentage points, but overall still relatively high occupancy levels. Their new asset that came online, which is Capital Spring, was also very, very well received. I think occupancy is in the high 90s. They also managed to do some acquisition that will help them with their DPU recovery in terms of their retail portfolio. So their retail portfolio is actually quite evenly distributed between downtown malls and suburban malls. So the suburban malls, as we know from, similar to FCT kind of portfolio, they've been doing well, resilient. Occupancy has recovered back to pre-pandemic levels. We can expect maybe positive reversions coming in the next few quarters. Whereas your downtown malls, downtown malls is a little bit more unique in the sense that they have your Raffles City, they have your Bugis Junction, they have Plaza Singapura. So all of these assets are still located quite near to your office. So I do expect them to benefit from the return to office. And I think the amount of, so I think that will be the main pickup, even though I think that as downtown malls, they still will be impacted by the lack of tourists or the slowly returning tourists. But overall, I think less impacted compared to the likes of your Vivo City and the likes of your perhaps Paragon, Taka malls. So they're in a bit of a sweet spot. So because of their very diversified, their diversified portfolio, downtown malls, suburban malls, as well as your office asset, I think that they're expected to be quite stable, but experience some sort of recovery from this reopening. Yeah. So I think that is more, CICT will be more of it is also a recovery play. Yeah, but I think earlier I flashed the DPU growth, or rather the DPU FY22 DPU forecast versus 2019. It's still not back to pre-pandemic levels. Yeah, but do take note that this is of course just comparing against CMT, which is pure retail. Yeah. I think that's all for me. There's a question. Yeah.
Sorry, go ahead, Natalie, if you have any. Sorry to interrupt you.
Oh no, I just want to tell you there's a question for SPH. Yeah.
Yeah. Okay. Okay. Oh, thanks. Can you just flip the slide to the SPH? Let me just try to address this. Yeah. Okay. Okay. So thanks for the questions. There are actually two questions here, but I guess one of it is, what was the takeover price for SPH REIT? So let me just explain. So SPH owns SPH REIT 66%. If you look at the table, the blue bar here at 66. So when Cascaden made an offer, it wasn't 236 in the original, but let's say they made the offer at 236 for SPH. So the trick now is that, so you make the offer for SPH. So what about SPH REIT? You own more than 30%. So the SIC, which is they control the takeover. I mean, they're the ones who give guidance on it. So they said, what price should you pay for SPH REIT? Because for SPH, at least you make you say I want to buy for 236. So for a chain takeover offer, they said that it would be the 20 days weighted average price when the the day they made the offer. So the price that they came out with, which was sorry, it's very small here. You probably need a binoculars to see it, but it's 964. The one at the bottom right, sorry, the footnote here is 964. They announced. Okay, so that's number one. Then to make it even more complicated, again, very small font. You probably need binoculars to see. After they made the offer, SPH started to pay. Let's say they made the offer in November 21. Then SPH REIT started to pay some dividends. They announced. So then Cascaden say, wait. So you gave the dividends. My offer also includes the dividends. I mean, it's my entitlement to say that. Of course, he's gonna do it. Like, of course, he says entitlement. So you can see that the offer is not 96.4 cents, but it will be 96.4 cents less the 1.24 cents dividend and the 1.44 cents dividend. So it's very small at the bottom right, but. So you won't get 96.4 cents for the SPH REIT, assuming you own it, but you will get it less the dividends that they paid. Yeah, no, yeah. So yeah, I hope that answers it. I hope I don't make it even more confusing. But it is basically the 20-day weighted average price. When they made the offer for SPH. So the other question was the SPH offer of cash and the SPH REIT. The SPH REITs provided taken from the current pool or new issues relating to possible dilution? Oh no, so there's no new shares or SPH REIT. The shares that you're getting, that 0.782 is the shares SPH will dividend in specie. So because SPH owns the REIT, right? They own 66, so they will give you the 160 something cash and the SPH REIT. So which in a way is like giving you back the REIT shares that you already own. You already own 66, but anyway, so that's what they're offering you. They're giving you cash and SPH REIT. So there is no new SPH REIT shares being issued. It's the existing pool of shares. Yeah, sorry if it's might be a bit confusing, but because you can't see but. Okay, views on Olam, still a buy or hold. Okay, we don't cover Olam, but we still think that the restructuring can get some value. So that's the recap. So Olam's market cap is 7 billion. And then they're going to split two of their business. Olam Agri, which they sold to one stake to the Saudi, that's worth 5 billion. So the next one is the one that they're going to list in London. Of course, nobody knows. I can do a calculation. Our guess is 8 billion. Okay, this is purely guesswork. But one other way to kind of double check the valuation is that if Olam Food wants to be part of the FTSE 100, you need a market cap of at least 5 billion. So maybe the low point, maybe one low valuation could be, again, like 99% guesswork here, but if they want to be FTSE 100, since I'm a Temasek company, right, I want to be in the FTSE, at the very minimum, your market cap needs to be at least £3 billion, which is roughly about 5 billion Sing dollar. So we still think there is a good chance that the restructuring could benefit shareholders. Yeah. Again, no, there's no news, but that is our own view. So we still think that maybe Olam could be attractive at these levels. Yeah.
Okay, hi. Sorry, I missed this question earlier. How do you see the impact on our REITs with the rising interest rate? So I think just now I was talking about it, about how at this rate of the yield curve flattening, or rather the narrowing of the yield spreads, that we could potentially see a rally in the REITs. I also mentioned earlier about the high interest rate hedge for the REITs in general, averaging around 72%. If you look at the REITs monthly that I published just last week, I believe, figure 16, last 4 columns, last 5 columns, you can see that I actually tabulated the interest coverage ratio, cost of debt, percentage of debt on fixed rate, debt expiring in this financial year as well as the next financial year. All of this data is available per REIT in part of our REITs monthly. So if you're really concerned about about this interest rate, you can have a look at the REITs monthly. Apart from that, I think 72% hedged, meaning to say that yes, I think for those REITs that will have refinancing coming up this year, probably that you will see an increase in cost because of debt. But also I think the market is also pricing in, more probably some rate cuts in 2023. So the one of course is market sentiment. Nothing is set. Even the FOMC dot plot projection is not set, it's a forecast, but then this is what the market seems to be pricing in. So meaning to say that for the past few months, I think the REITs have been under pressure because of these headwinds, the interest rate headwinds. People thinking that this leg of the cycle of interest rate hikes, it will affect the REITs negatively, which it will. But of course, there are other factors to take note of, which is the interest rate hedge, the amount that's expiring, also the kind of initiatives that, or rather DPU growth initiatives that the REITs have already embarked on in 2020, 2021 that will help grow DPU. Of course, it will be taken away by a bit of the escalation in cost of borrowing. Yeah. So overall, I think we are still optimistic about the REITs, but we are aware that the rising interest rates does have an impact on the REITs in terms of cost of borrowing.
Okay, I think Natalie's probably frozen. I think Natalie's video is frozen, but okay. Let's try to answer as much as we can before we try to wrap it up. Where can I get your REITs monthly? Yeah, I think Natalie it's probably in our morning note or in our stocksbnb.com. Yeah. Okay. Okay. Let me just try to answer as many as we can. Then we can kind of yeah. Natalie, you want to continue? Or?
Did I get cut off?
Yeah. You were frozen in time.
Okay. Yeah. So I think, okay, in general, to wrap things up, how I think about REITs in this rising interest rate environment, there might be cost escalation. Cost of debt escalation really depends on the kind of hedging as well as the amount of debt that is expiring in this current FY. And overall, a lot of the REITs, they have actually been very active on in terms of portfolio rebalancing, portfolio rejuvenation. So that will of course help to grow DPUs, even as some of the accretion is being taken away due to rising cost of borrowing. Yeah, but overall, still quite positive on the REITs. Yeah, that's all for me.
Okay. Okay. This one is okay. Let me try. Hi, Paul. Can you share your insights on the SGX listed REITs refinancing issues? Yeah. I think this one is why do they have this problem? I think all this started with the 3 red lines. It's probably no coincidence that when the 3 red lines happened, some had issues. And if any company or even if your parent crossed that, then I think it's the 3 red lines, right? So you cannot cross this line. This one is called 3 lines. So I think that was the reason why they had all these issues. Yeah, and I think if any more Nat you want to jump in, but my own general thoughts on Chinese REITs is there's a lot of leakage in Chinese REITs. There's a lot of tax leakage. Nothing wrong with these companies, just that every dollar they collect, like we mentioned before, they got to pay property tax, corporate tax, every kind of withholding tax. By the time you reach as a shareholder, you've been like taxed, I don't know, the leakage maybe 10% or 20%. So that's always been the issue for me for just Chinese REITs in general. But Natalie, if you got anything else you want to share? Yeah. Okay, let me just move on to again the SPH REIT one. Hi Paul, does it mean SPH REIT shareholders has the option to accept or reject the cash offer? Yes, yeah. Yeah, you're right. There will be a general offer, and again, then it will be the same thing. If that's assuming, yes, an interesting one. That assuming SPH REIT there's an offer, yeah, then it will again be up to shareholders to accept. But they have not really mentioned what they want to do with the SPH REIT. They did not mention is this the key things is this a final offer? Is this they want to keep the listing status? So they haven't really mentioned that, but yeah, it will be up to investors whether they want to accept the offer. Cascadian could still hold the SPH REIT or would likely sell out SPH REIT. I'm really not sure. Because if you want to, I mean, there's no value of owning a REIT if you don't, it's not listed, right? So that one I really not clear. They didn't really mention in their announcements their real intention. I mean, or if they did, I didn't see it. I apologize for that, but I didn't really see that part. I've not seen, because normally in a cash offer document, they will say whether they want to keep it listed, or I didn't really catch that. So I need to double check on that. But so far, I don't think they've not mentioned anything on it, or is it a final offer? Yeah. Okay, there's one bank. Okay, let me just try to answer some. Okay, Jardine Cycle and Carriage price has been appreciating. Is it recovery? We don't cover, but again, Jardine Cycle and Carriage is like a proxy to Astra International, because 80% or even more, 80 to 90% of the profits come from the Indonesian listed Astra International, and that has also done well because of the whole reopening, because Astra has auto and Astra has mining equipment rental, and they also have a mining business. So it's really just a play on Astra. So that's why it's recovering. Yeah. I hope that helps. So if you go the Indonesian Stock Exchange, the interesting thing, I guess, this time around for Indonesia is that if you look at the exchange rate table, the Singapore Indonesian exchange rate has been pretty sturdy, considering the other developed countries that depreciated. Yeah. Okay, thanks. I'll hand it to you, Natalie.
Okay, I'll just touch a little bit more about the SGX China focused REITs and their refinancing issues. Why do they have these problems? So I've actually spoken to some of the companies, these China REITs, and one of the reason, I of course I was asking, why is it that all your loans are like all together and like not like separated? Why can't you do like by property instead, so you don't run into these kind of problems? So I think it all started at IPO, because during IPO, first of all, some of these REITs, except for CapitaLand China Trust, which is of course sponsored by CapitaLand, which is a local name, and we all know all these other names, I think they are smaller sponsors and less well-known sponsors, but due to that reason, I think they have more limited access to capital or debt financing. So and some of these when they do get borrowing for their IPO, they take like syndicated loans, meaning to say that there are many banks that come together to then underwrite this loan for the banks, for the REITs, and sometimes come time of refinancing, some of them may be a bit anxious, especially for for Tasin. We saw that for Tasin. So then that's when some parties want to include some clause, remove some clause, etc. So then I think that helps, that really delays the process of renegotiation. Yeah, so I think it really, when I ask them why can't you do it like by property, so then I think it becomes more difficult, because there are certain assets within the property that might be deemed more attractive, jewels, compared to others. Whereas, and that might mean that there might be different costs of borrowing. Meaning, okay, for example, if I were to lend you money to buy ION, maybe I will give you a lower rate of financing, versus if I were to lend you money to buy, I don't know, some small mall in Yishun, the Podium or something. So then that will be make it more difficult for the REIT, because then all the lenders will want to lend only to finance the very good jewels, isn't it? So I think that was one of the reasons that they try to explain like why it's more difficult for China REITs, like the reputation wise, and of course it's not easy to get individual mortgage loans. It has to do by property. So when it comes to property financing the property, then it becomes a larger quantum. Then you need a lot of parties to come in to lend. And then when some parties, at come time of refinancing, they want to pull out and they want to add on more clauses, and it delays the process. So I think that sort of explains one of the reasons why some of the China REITs they seem to have a little bit more difficulty. Yeah, I hope that helps. Don't quote me on this, but I hope that helps with the understanding. That's all for me.
Okay, let's try to. Oh, sorry. Glenn, please go ahead.
Yeah,
sorry to interrupt.
Yeah. Okay. Sorry, Paul. So I'll just take the one about the bank question. So why are prices of DBS, UOB, and OCBC dropping for the past week? One of the reasons might be because they are realizing their profits, so they're just, they're selling their shares so they can get profits from when they bought it at a lower price. Another reason also might be because from the US results. So maybe some are expecting that this would happen the same. Sorry, this would be a reflection of what will happen for Singapore. But as we explained earlier, there are specific reasons why the US are quite different from Singapore banks. And are we still overweight on the bank shares? Yep, we are. As mentioned also for the various reasons why Singapore banks are more isolated from what happened in the US. So I think that's all I have for the banks. Hand over to you, back to Paul.
Okay, thanks, Glenn. So let me just try to finish off whatever we can. So sorry, this is a China question. We don't cover China. So how can China be loosening rates while everywhere else will be increasing rates? And if that works, how much positive push would that give? Yeah, we can't. Sorry, we don't cover China. But like we mentioned earlier, they are lowering rates because the inflation is low and the economy is slowing down. So that's why they are lowering rates, which is counterintuitive to the whole global economies. And how much push would they give to the A shares? We can't, because all these tech names, which is nothing, may not be so much to do with the economy and more to do with the regulatory framework. Yeah, again, that's the most diplomatic answer. But sorry, China we don't really cover, so we can't really give you a good answer. Paul, your view on Yang latest development of the spin-off. Yang restructuring is looming. Many analysts has made a buy call even to $2 plus, but yet the price is not moving. Yeah, I think we've been asked before. We don't cover, but let me just share our views again for the Yang Financial. Firstly, you want to buy China, why must I buy it through Yang Financial, the spin-off? Just those who don't know, so Yang has a yacht and a financial arm of the business, which is lending and investments, also known as hedge fund. But anyway, they have a finance arm and a shipbuilding arm. So they're spinning off the shipbuilding arm and dividend in specie to shareholders. So again, I just don't have answers. Like if an investor would ask me, so why must I buy the financial arm? There are so many shares to get exposure to China. I have no answer to that. Number one. Number two, why must I pay so much for financial arm when the banks are trading 0.4, 0.5 times? Again, I also have no answer to that. So that's why I really not too sure. And the third is, if I want to play a restructuring story, I'll rather run with the Temasek link companies like Keppel or even Olam. And you've seen how Temasek have done well with a lot of the restructuring names. Again, this is our general answer we give. Sorry, we don't have like deep insights. I don't have a financial model or anything, but this is just thematically the answer. I don't see why I need to buy a Yang Financial. They are like, I don't know, 5 of the biggest banks in the world listed in Hong Kong. Do I have to run over to buy it here to get China exposure? Yeah. Okay. I think with that, I would like to thank everyone for your for your questions and thank you everyone for your time. I know some people had issues with the logging in. Some of it was actually not due to us, due to the Zoom issues. But again, thanks everyone for your time and your questions. Hope to see you next week. Thank you, everybody.